Good evening. I'm Liz Krueger, the state senator for much of Manhattan Island and all of Roosevelt Island. I'd like to welcome the program attendees who are viewing this event on Zoom and Facebook, or who are calling in to this virtual town hall series about the power of investing, stocks, bonds, and alternative assets. As always with our webinar, we have closed captioning of today's event. As a viewer, you have to activate closed captioning to view the text on your device. If you're watching in Zoom, click on Live Transcript in the meeting controls to start viewing closed captioning. And if you're on Facebook Live, you'll see a setting button on the bottom right-hand corner of the video. Click on the CC closed caption to activate the process. This forum is being recorded, and everyone who RSVP'd will receive an email with links to the event video, the resources that are posted in the chat within a few days, along with the presenter's PowerPoint. So even if you are fascinated and want to write down everything, and you can try, we're also going to send it all to you so you will have it available to study as you wish and to draw down from the resources as you wish. Before we begin tonight's program, I do need to do an update on COVID. As you may have heard, we are experiencing a new COVID-19 wave. Even though this wave is not as severe as other waves in the past, hooray, it is causing a number of COVID infections and hospitalizations to increase. So particularly if you have any kind of respiratory issues or immune deficiencies, or above the age of 60 or pregnant, you want to make sure that you are one of those first people in line to get the new COVID vaccine. You might also want to start using a mask in public and around large groups of people. But again, the doctors in the know say that the best way to protect yourself against COVID is to stay up to date on COVID-19 vaccinations, and a new one has been approved and released. So even if you think, oh, I took the vaccine, oh, I took boosters, and that's great. If you haven't had COVID for the last 2 months and you haven't been vaccinated and you're 6 months old or older, you really want to go ahead and get that new COVID vaccine. Resources to help you find the sites and how to make appointments are being posted in the chat. We're a little behind here in New York City getting enough of the appointments scheduled, but we're getting better and better. Our office has been informed that insurance providers, including Original Medicare, Medicare Advantage, commercial health insurance providers, are busy updating their billing systems, and that is what's delaying more of the COVID vaccine is being available through pharmacies and other healthcare locations. You can, of course, check with your insurance provider to make sure you're covered. And you can also check with your personal doctors to see if they might have access to the vaccines quicker than you can get through the lines to apply in many of the pharmacies around the city. I know I got an appointment today for about a month from now, and I'm glad I got it. Finally, the Biden-Harris administration will distribute another round of free at-home rapid COVID-19 tests to each household. Beginning September 25th, each household can place an order for 4 tests, which will be delivered by regular mail. The website for these tests has also been placed in the chat. So now moving on to this evening's event. This is the third part of a 3-part financial roadmap series we're doing this year. To guide us through our journey this evening, we have 2 additional members of the Financial Planning Association of Metro New York who's been a partner in this whole series. Tonight's session is titled The Power of Investing, Stocks, Bonds, and Alternative Assets. Our presenters this evening are Erin Slocum, a certified financial planner who is president of the Financial Planning Association of Metro New York. And also joining Erin is Edward Hadid, who's also a certified financial planner and a board member of the Financial Planning Association. After they make their presentation, I will moderate a Q&A portion of tonight's event. And many people gave us questions in advance, but if new questions come to you as you're listening to our presenters, you can, of course, enter them in the Q&A option of whichever system you're on. And if we have time to add your question to the questions being asked, we will do so. So with that, I would like to turn it over to Erin and Ed and welcome them. And I'm so glad you're both with us this evening.
Thank you,
Senator.
Thank you so much, Senator. I'm going to share my screen. And then, Erin, can you confirm that we can see that? Oh, I don't know if you could confirm.
You're good.
Okay. Thank you, Senator and staff. Erin and I are very happy to be here. My name is Ed Hadid, with the Power Investing Stocks, Bonds, and Alternative Assets. So, as Senator mentioned, Erin and I are both CFPs, or certified financial planners. And I know we're here to talk about investments tonight, but we just wanted to stress investments are only one component of a comprehensive plan. This is the third part of a series. Last time was taxes. Before that was debt and credit. Here we have listed the other components that are really important. Before you even get into investing, you need to be able to identify your goals, get a handle on your cash flow, determine your emergency fund, think about goals like retirement or education, have a good handle on your insurance and taxes. If you're still working, you want to optimize your employee benefits, get a handle on your liabilities, and also estate planning is very, very important for all stages of your life, but particularly if you're in your 50s, 60s, 70s, or above. It's very important to get that in line. So, questions to ask. Investments. Before you even get started in what different types of investments there are, the main questions you want to ask yourself is, what are my investment goals and what is my time frame? What is this money supposed to do for me? Is this supposed to be for income? Is this for a specific goal or future need, retirement, education, perhaps a legacy or inheritance? Should this be an emergency fund, in which case I'd argue it shouldn't be invested at all? Or is it for general wealth accumulation? So you want to start with that time frame, or start thinking about that first. Then you want to ask additional questions. How much do I have available to invest? Do I need this money available in a short amount of time? That's speaking to liquidity needs. There's certain investments that have lockups or penalties if you try to access them earlier. Then more specifically, can I quantify this goal in dollars and time? For instance, do I need $50,000 a year starting in 10 years, perhaps to supplement Social Security? So before jumping into what to invest in or how to invest, these are some of the questions you want to start asking yourselves. And then, what is my risk tolerance or / comfort level? So the questions I mentioned before probably make sense, but what does that mean? What is my risk tolerance? So when we speak about risk in investments, there's lots of different types of risk. But the main thing we're talking about here is this word volatility, and that means the variation in price. You may have heard newscasters mention this on reports about the stock market. So when you're looking into investments, take a higher risk with the expectation of getting a higher return, since you might get a higher reward. The higher the risk, however, there's also a chance you won't get that expected return. So in a minute, Erin's going to talk about a little bit about the different asset classes and the different risk associated with them. But you have to ask yourself things like this. Can you tolerate seeing the value of your investments rise from $1,000 to $1,200? Well, that sounds pretty good. I think we could probably all tolerate that. But could you tolerate the value of your investments going from $1,000 down to $650, or $10,000 down to $6,500, or $100,000 down to $65,000? Hence a 35% drop. Could you get comfortable with that? Would you be able to sleep at night? So this is the concept of risk tolerance. We're going to get a little bit more into that. But as I said, before you actually get into the investments, you need to start asking yourself some of these questions. So at this point, I'm going to turn it over to Erin for a few slides.
Thank you, Ed. So to put this risk and conversation into some context, and as we segue into the specific asset classes. These are this is a chart plotting the range of historical returns of stocks, bonds, and cash. And cash here is measured by a 3-month US Treasury bill. It's essentially a cash equivalent. So where you have that risk, we're talking about volatility, you can see the range of returns of stocks on, at the highest, they've been up 53% in 1 year. And then you can see the drawdown of almost 44%. But on average, over, again, since almost 100 years, stocks have returned an average of just over 9.5%. And then moving to bonds, you see, which in terms of the risk spectrum, which we'll see in a moment, are generally less riskier than your stocks. The range of that volatility decreases, but you can see that your upside is not as high as stocks, but your drawdown or downside is much lower historically as well. And then cash, you can see again, it is quite safe, but you are not going to get anywhere near the upside potential of the stocks and even the bonds. And so this is just something we wanted to share to put all of this in context, and as we talk about risk and in each asset class. So Ed, if you could go to the next slide. So these are the main types of investments, or what we call asset classes, that one can invest in. When you invest, you divide your money over these various asset classes, depending on your goals and time horizon, again, which Ed just talked about, you want to think about before you even begin. And each bucket serves a purpose in your portfolio. This is called asset allocation, and we'll get into that a little bit later. And just to cover each one, we'll do a deeper dive in a moment on stocks and bonds, but just briefly going over these 4 main asset classes now. You have your cash and your cash equivalents. So your main goal here is stability. You probably won't lose money with these investments, but you won't gain a lot either if you think back to the graph we just showed. The main risk here, that's great, I can't lose money in cash, wonderful. But what you're risking is that your money will not beat inflation. So inflation, your increasing prices, can erode over time the value of your dollar. So these are really best, cash and cash equivalents are best for your short-term goals and cash needs. Things like checking, savings, certificates of deposit, money market funds, and those short-term US Treasury bills. So if you're thinking for your emergency fund, you want to have cash immediately available that you won't lose, that's kept in a checking or a savings type account, right? Then we're moving on to bonds, and the next level on the risk spectrum here. Essentially, you're loaning money to an entity, a government, or a company. So an investor would invest in bonds, one, if they're looking to get a stream of income, they would allocate here, and are one looking to offset some of the larger risk of their stock investments. So essentially, again, thinking back to the chart or the graph, you receive a moderate return in exchange for a moderate amount of risk. With stocks, you're buying a piece of a company. So stocks moving up on the risk ladder, slightly more risky or volatile than bonds and cash. And the main goal here is growth. So as you saw, over the last almost 100 years, you make as much as 52%, again, on average, 9-10%. But you are looking for growth. And again, that comes with a larger amount of risk. Then your alternative investments, it's essentially a catch-all for anything that isn't a stock or a bond. So real estate, commodities, which are metals such as gold, oil, cryptocurrency, collectibles that you're buying, hoping will grow in value, stamps, baseball cards, art, would all be this alternative investment asset class. And alternative strategies are very nuanced and require a deep level of knowledge and understanding, especially of that specific type of asset. So they're generally suited to more sophisticated investors. And many you cannot legally invest in unless the investor meets certain criteria, such as a big one is net worth or investable assets. There are thresholds here. And really the point of like, well, why would I have an alternative? Or what's their purpose? Really, we're looking for things that are, because they're not a stock or a bond, they're uncorrelated or less correlated to stocks and bonds. So you're diversifying some of that risk. And we'll talk a bit more as well about diversification in a few moments. And a question had come in previously on crypto, and I'll just comment. I mean, this is again my opinion. Well, fact, it's a risky investment, and although it's moving this way, it's a very highly unregulated market. You've seen a lot of news about bad actors, bad companies out there recently. So there's potential for a lot of growth, but definitely extreme volatility. So again, my opinion, it's not necessarily appropriate for the average investor. Next slide, please, Tim.
Ed.
Sorry, Ed.
And also, Erin, I wanted
Yeah.
to mention in the alternatives, that you've got your venture capital and your private equity, and so there's some of the things they get very hard access to and are those riskier assets.
Yeah.
Here we go.
So deeper dive now into stocks or equities. Essentially, you're buying a piece of a company. So you become an owner in whatever percentage of your holding, right? So probably for us, it's a very, very small, minute sliver, but we still own a share of a company. Some of these companies pay a dividend. So there is sometimes a stream of income that one can receive by investing or buying a stock. Not all companies pay a dividend, and rather instead of paying a dividend, they reinvest excess earnings back into the company. So you're hoping for more growth rather than necessarily income in those dividend paying stocks, or growth stocks. As there are various asset classes, the same goes for stocks. There are several sub asset classes. So you can see on the right hand side different types of stocks or sub asset classes. So you can buy stock in US domestic companies. And again, from our perspective, right, they're US. There's also non-US, international. And even then that can be broken down into developed countries, so such as France or Japan, Germany, or emerging markets. So Argentina, China, India would be considered emerging markets. And again, even within these sub-asset classes, there's a various risk spectrum as well. So emerging markets would be riskier than, let's say, your US large cap companies. So speaking of capitalization, you can buy stocks and companies that are large, mid, or small. And capitalization is essentially just measuring the total value of the company's stock out there. And it's indicative really of the company's size. So small cap stocks, you're looking at, generally under 2 billion in size and issuance outstanding. Mid cap companies between 2 and 10 billion. And then large cap, you're thinking your Apples and Googles of the world, would be over that 10 billion mark. Something I'm sure many of you have seen also just reading or in the news, this is growth in value. This is a tilt, right? Or like what kind of company is a growth company or a value company? So value, that companies are typically larger, more well-established, that the market thinks are undervalued. And again, this can change, right? Growth value, depending on where the market, how they think a company is priced. But generally, again, these value companies pay high dividends. versus growth companies. They're relatively stable with lower volatility than their growth peers. And on the flip side, growth companies pay a very low dividend or none at all. Like I mentioned earlier, they're reinvesting that back into the company. So you're hoping that over time, the company, your investment will appreciate greater than, let's say, if you buy value-oriented companies. Ed, next slide, unless you have any comments. Okay. So how do, where are stocks traded? Just on a stock market, right? We've heard of the New York Stock Exchange. It's here in New York. NASDAQ, there's no physical location, but a lot of tech company shares trade on the NASDAQ. And just like a regular market, the seller asks for a price and the buyer bids a price. You can't buy on the market yourself. Only members of the stock exchange can. So you'll go to a bank or a brokerage house who has a relationship with a member of one of these exchanges, and you buy your investment through them. So like a Charles Schwab is a common large brokerage house. Just a comment, because we'll be talking about this soon. Mutual funds are not traded on an exchange. You'll buy them directly from the financial company that manages that fund, such as a Vanguard, or through an online or full service broker. Again, a Schwab or a Fidelity, etc. Next slide, please. So bonds. Like I mentioned earlier, it's a loan. You're lending money to a government or a company. And because you're loaning money, you expect to receive compensation for that. So that's what in return, you get an interest payment or a coupon payment. Again, similar to stocks, there are different kinds of bonds. So I'm just going to take some water. Government bonds, we have our US federal government called treasuries, and then non-US or sovereign bonds. So countries all over the world issue bonds to raise funds. So government bonds, whether they be federal, foreign, or municipal, which is your local governments, it's a way for them to raise money from the public. And same thing with the corporate bond. A company wants to raise capital. And corporate bonds are issued by both US companies and non-US companies. And again, within the corporate bonds, you have investment grade, which are higher credit quality companies, and high yield, so lower credit quality, riskier companies. And just a quick note on treasuries for the US, there's 3 different kinds, which you'll see. You have treasury bills, and those mature in less than 1 year. Treasury notes are kind of that intermediate term, if you will, where the government issues notes with 2, 3, 5, 7, and 10-year maturities. And then you have treasury bonds that have a maturity that's over 10 years. And next slide, please. So bonds, there's a lot to think about when you're looking at an individual bond. So what are we looking at? What is the interest rate? What's the coupon? This will, if you're looking for income, this is a good indication. Now, typically, the higher the coupon could indicate a riskier, excuse me, or a lower credit quality company, because an investor wants to be compensated for the risk that they're taking. So if you're looking for more income, you could see higher coupon payments, but just again, let's look at the credit quality rating. So I'll just jump to the third bullet. What is the quality? Like, what is quality? There are 2 main bond rating agencies, Moody's and S&P's, and what they do is they assign a rating to every, and most every bond that's issued by a company or even a government. So you can see basically anything from that AAA to the BBB is investment grade. So these are higher quality companies, and then anything below that, or governments, anything below that would be what we call kind of junk bonds, high yield. The time to maturity. So what is the maturity date? So when is it going to be paid back? Bond prices and interest rates move in opposite directions. So this is what we call interest rate risk, where rising interest rates could push bond prices down, and vice versa. Falling interest rates pushes bond prices up. And those longer term bonds, which is anything really over 10 years, are more sensitive to changes in interest rates. And short term is about 1 to 3 year maturity, and intermediate's really anything in between 3 and 10. Next slide, please.
Sorry, there we go.
So how do you invest in a stock or a bond? Of course, there are individual companies, stocks, and there are individual bonds. Pretty straightforward. Other ways you can gain exposure to the stock or the bond market are through mutual funds and exchange traded funds. Within mutual funds, there's managed. So this is what we call active. So active management versus passive. So you have an index fund, an index mutual fund, which tracks an index. And same thing with an exchange traded fund. Those are passive. And passive is the most cost effective. So the fees are typically lower. With actively managed funds, the fees are higher because you're paying for a professional manager to carefully track the underlying investments and make adjustments to the asset allocation or the makeup of the fund. And there are some cases where it's worth it to pay more. So, okay, well, why would I buy anything other than an index fund or an ETF, right? For example, in emerging markets, where the space is, it's volatile, it's inefficient, there's not a lot of knowledge out there. So typically a manager that's good at their job, it typically pays more often than not to be active in emerging market stocks. And that's why you want to do your research, and we'll share some resources at the end. And basically a mutual fund, and similar to an ETF, it's a type of investment where one investor pulls their money together to purchase a basket of securities. Next slide, please. Just spending a moment talking about the differences, mutual funds versus ETFs. Pretty straightforward, but essentially, I mean, what they both have in common is instant diversification. These are my favorite investments personally. You can invest in stocks, bonds, other investment instruments, and again, get that instant diversification. The index mutual funds and ETFs try to replicate the performance of an index. But then their difference is mutual funds are traded only once a day after the market's closed. So you can see in this chart, there's only one price a day, versus an ETF, you can see while the market's open, that price is constantly moving. So they're really traded like a stock. Lower cost, like I mentioned, for ETFs, more tax efficient than actively managed mutual funds. So that's where we see, because that active manager is constantly trading within the fund, There could be higher turnover, generating gains, which have to get pushed out to the investor at the end of the year. So there's no control in actively managed mutual funds. And then with mutual funds, some of them do have a minimum amount you have to invest, like $500 or $1,000. ETFs you can buy. There's no minimum. Again, it's just like a stock. You just have to have the money. So mutual funds also can charge fees, like we call them loads. So to even buy a fund, they might just charge you something just to buy it, right? And that's not even a commission charge. So that's where it's important to just do your research on any mutual fund and even ETF, just to make sure you have an understanding of the costs involved. So with that, I will turn it back to Ed.
All right, thank you, Erin. So Erin has given an in-depth description of all the different kind of investments we have. So now I want to get back to risk and what we call asset allocation. So how do you divide that portfolio between stocks and bonds and cash? And here are just a few samples. In the higher risk column here, we have stocks 80 and above, perhaps bonds 20. So this is what would be called an 80-20 or a 90-10 or a 100-0. That will be the highest risk, because it's going to be all stocks and it's going to have more of that price movement. The middle column here would be more moderate, and that's your classic 60-40. You may have heard of that before. You may be invested like that already. It's a well-performing asset allocation over time, and it seems to be something most people can get comfortable with. If you move to the third column, you're looking at something more conservative. You're going to lower that allocation to stocks and look more like a 40-60. Now, these are just samples, and it's totally dependent upon what stage you are in life, what are your goals, what kind of risk can you handle. But we just wanted to give some examples of different portfolios. And just a couple notes here: the higher the risk is, again, the higher potential gain or potential loss. Okay. This is a beautiful chart called the Callan Periodic Table of Investment Returns. Each color here represents a different asset class, all the different things Erin was talking about. Each column is a different year, and it's showing which performed the best. So if you take a moment, can you notice the pattern here? Has anyone noticed the pattern? Okay, sorry, it's a trick question. There is no pattern. The point of this whole thing is that every year there's something different. It's impossible to know what is going to perform the best. And this is why you want to diversify. So if we look at last year in 2022, cash was actually the best. It was a poor year for most investments. Cash came out as king at 1.46%. High yield bonds behind that, all the way down to real estate at the bottom. If we go back 10 years, it was more like real estate at the top, and then emerging equities, emerging markets, international. So the point of this is that a well-diversified portfolio is always going to have something that's probably performing well, and you're probably going to have something that's not performing well. But that's the point. You are spreading the risk around, and nobody knows what's going to perform the best. Erin mentioned a couple more types of risk here. I'm going to just skip over this because in the interest of time. Oh, there's Senator Krueger. Do I have 1 minute or 2 minutes?
One more minute. Yeah.
Okay, 1 more minute. Okay, I'll go through this quickly. Other things just to consider, and as Senator Krueger had mentioned, you're going to get all these slides so you can read them, but short-term goals, what we consider that 3 years and under, you obviously want to have something safer. You think about more like cash. Intermediate goals, 3 to 8 years, that might take on a little bit more risk, more bonds, some stocks. Long-term goals is where you're looking at that fully diversified portfolio. Here are some just actionable strategies. Create an investment plan with a proper asset allocation to fit your goals and risk tolerance. I do want to mention some mindset things here in closing. Good investing should actually be kind of boring. You shouldn't be racing to your computer every 2 hours to see how your stock or portfolio performed. It takes time, it takes patience. There's going to be some losses, but it should be something you check in with every, say, couple months or so. And there's some other just things to think about here. Lastly, I will just mention the different types of investment accounts. You have a brokerage account, which is a typical account. You can make any investment in there you want. Money can move in and out. Gains are taxed as capital gains, either short-term or long-term, and that's based on whether you hold it under a year or over a year. And then you have your IRAs and 401ks, which are retirement accounts, and there's just some details there which you can look at after. So thank you very much, and I guess I'll turn it back over to you.
Thank you both very much. And I'm sorry I had to cut you off. I gave you a few extra minutes because I was thinking it was so important. You know, we didn't get that many questions that aren't sort of very personal. So I'm going to start out with the one that I think is the one everyone in life has if they have some money that they think they want to invest. How do you find an advisor who is affordable and trustworthy? And am I right to believe that trustworthy includes being neutral or disinterested, meaning not steering me to some specific fund that they're making money from, or rushing me to constantly turn over my account? One of the things that you just said was, don't be thinking you need to do something all the time. Don't be looking at your account several times a day. I mean, there are some people who actually have a fiduciary responsibility to work in your best interests, and others who are in the business who actually have a responsibility only to make money for their company or to increase their revenue from buying and selling so much. So this is the question people ask each other all the time. How do we do this right?
I think this is a good plug for finding and working with a certified financial planner. And there is in the last slide some resources where we do include a link on finding one, but a certified financial planner has a fiduciary responsibility, which means acting in the client's best interest, not their own. There are different, depending on who you work with or what firm they're at, or what type of firm, their fees could be different or their fee structure, but they are bound by this fiduciary duty. So my answer to that question, I'm sure Ed's, but I'll let him add anything, would be to work with a certified financial planner.
Yes, I agree. I think you should if you're doing research, or even if you're working with someone right now, you want to ask them, how are you paid? I'd like to know, how are you paid? Are you working for me, or are you selling some type of products? I personally feel the firm I work for the fee structure is fee only, which means we are only paid by our clients. We do not make commissions from anyone else. We did not get referral fees. We work for the people across the table from us. And I think that's important. And it doesn't have to be that way. But I think if you're looking for an advisor or you're already working with one, I think that's an important question to ask. I'd really like to know how you're paid, and are you fiduciary at all times? When you're working with me, I want you to be a fiduciary. So those are two main questions to start with.
Great, thank you. So I think Erin mentioned a question about crypto earlier. So people, and I personally agree, this is not a great investment proposal for anyone who doesn't really A, know what the hell they're doing, and B, can afford to lose money. That's my view. But people now are asking, what is crypto? How do you explain what it is? Even though I'm going to agree with you, I don't think you ought to be buying it.
I can. So crypto being cryptocurrency, sure, we've seen in the news things like Bitcoin, Ethereum. There's these what we call NFTs, not we, but the non-fungible tokens. I mean, it's not physical. Generally, it's not physical currency or cash. It's very convoluted. There's data miners or Bitcoin miners, and that's, I guess, as simply as I can explain it. But yeah, it's a very interesting space, but like I had mentioned, not regulated like the stock market, for example.
Right. We're actually exploring trying to regulate it more in state law, which also assumes we all can actually figure out what the heck it is.
Yeah.
But that's a separate issue. So several questions. When is a good time to invest? Is it certain months of the year? Is this a good time to invest? Should I be heading into specific sectors in stocks? I don't know how you answer that. How do you answer that?
One of the points I had on one of the slides we didn't get to is to try to avoid what's called market timing. And market timing is sitting on kind of the sidelines and, I'm watching the chart. Should I get in now? Should I get in next week? No, I don't, it doesn't feel quite right. Oh, no, oh, now things are looking good. It's just impossible. It's impossible to market time. And the point of that, of what I'm trying to say is, if you've asked yourself those other questions regarding investments, what are my goals? What is my time horizon? I got comfortable with somewhat on the risk spectrum. Then it's time to invest. I wouldn't try to time the market or wait for the next Fed decision or see who's going to win the next election. You really, there's plenty of charts showing where that a lot of that is just noise. Your best bet is just to make decisions for you, what's best for you, and get in. I realize emotionally that might be hard. So there are some techniques called like, our techniques, dollar cost averaging, for instance. If you wanted to spread that over, say the next 5 months or 10 months, maybe say you had $10,000, you do $1,000 a month. So you gradually get in. So you're not anchored to one point, but I would not, there's no better or worse time of year, even I believe the second part of your question was regarding sectors, things like that. Erin and I both believe in just, for the most part, a nice, well-diversified portfolio in mainly index funds, some managed. Stay away from individual stocks. Stock picking is really, really hard.
Yeah.
And even with sectors too, there are sector specific ETFs or mutual funds like a technology ETF or, I don't know, consumer luxury goods,
Healthcare, energy,
yeah, energy, right? So those are certainly sector plays, but what you're looking for, or what we recommend, is a well-diversified portfolio where you're not overly exposed or have so much sector risk there.
So there are lots of ads suggesting people invest in gold and gold coins. Is that actually a good strategy for making money or saving money?
Gold would be in that category that Erin talked about earlier. We put that in alternatives and commodities or metals. Gold is funny, right? It's been kind of valued since the dawn of time. Men have used it. Men and women have used it for money. It's considered a store value. For the most part, you can use it for jewelry. Central banks around the world like to buy it. But for the most part, gold doesn't really do anything, right? It just kind of sits in a vault. It doesn't pay dividends. It doesn't come up with new products. It doesn't innovate. It's not solving any problems. It can be a store of value. I mean, over the last 10 years, I think it's been virtually flat. Over the last 5 years, it's done pretty well, but I would not make it a cornerstone of any portfolio. If you want to allocate a small piece of it, or that helps you sleep at night, or you think it's going to perform well, I would, go for it. But I don't consider it like a worthy investment to build wealth.
So we touched on a number of different kinds of investment funds and stocks and bonds. So one of the questions here seems to tie into, so if you're going to choose to invest in bonds, what are the difference between these municipal and government and treasury bonds versus other bonds? I know one part of it is the taxes you pay and when you pay, but can you talk a little bit more about the differences?
Sure, I can take that one, and I actually skipped over that piece of the bond chart, but bond slide. Yes, you're right in that they're taxed differently depending on what type of bond it is. So a U.S. Treasury, a U.S. government bond, you're not paying any taxes at the state or local level on the interest that you get from holding that security. Municipal bonds, that's your local governments like New York City, Providence, Rhode Island. they're raising money for projects just like the federal government, building a highway or a school. The interest on those, on holding those in types of bonds, there is no federal, state, or local tax on that interest. So it's what we call triple tax exempt. And then corporate bonds and non-US government bonds, those income payments are subject to your normal income tax rate. So definitely be mindful of the tax situation, and kind of to the point, or to Ed's last slide, we didn't get to spend a lot of time on, but where you hold those bonds, those corporate bonds might make more sense in a tax exempt account, such as a 401k or an IRA, where maybe in your personal individual name brokerage account, you might want to look at owning more municipal or US government strategies, but that's a good question.
So somebody's just typed in, so when we talk about fiduciary responsibility to the client, are the big guys, they said Schwab and Fidelity, following the rules of fiduciary responsibility to you? How do those companies work?
Yeah, so Schwab and Fidelity are best known really as custodians. So they hold the assets. So many advisors work with those companies, where you open a Schwab or Fidelity account and you work with an independent advisor who can help buy things through that account. Now, Schwab and Fidelity also have their own advisors, and some of them could be CFPs and they should be working as a fiduciary. But again, the best way to kind of get to the bottom of that is just flat out ask them what capacity they're working, because they're going to have different business lines and different things that they might sell. But for instance, my firm uses Schwab, but I don't work for Schwab. I'm completely independent. But Schwab and Fidelity are the two big custodians.
And then going back to the discussion about paying you for, on fees, not for the other side of the coin. How much should a financial advisor cost you? Is it a percentage of the account that I'm setting up with you? Is it a percentage of what we hope I'll make on an annualized basis? How do I know the ballpark of what fees are?
I'd say generally, like, my firm, for example, I think Ed's, the fee only firms, we charge on a percentage of the assets that we manage. So not on expectations of performance. We do well when our clients do well, but the fee is based on assets under management. And just one thing I'll, to keep in mind as well, with a firm, with a registered investment advisor or a firm that does that, what we call the holistic financial planning, each of those points that Ed started out with, see what you get with that fee. And again, they range. So I can't say it should be X%, but you need to see what you're getting and all of the other areas. And I know some firms as well charge per financial plan. It really runs the spectrum. So it's,
yeah, I'd add, we don't charge a strictly an AUM fee. It's based on your assets. But there's lots of different models out there. There are advisors who could charge by the project or even by the hour. Some who don't take into assets at all, because some people might not have assets, but they do have financial planning needs, which is a lot of people. So there's a lot of different models out there. But going back to Erin's point, like what are you getting for that? I'd say 20 years ago, you'd pay a 1% fee just to have someone manage your investments. And now the world is moving closer, slowly, but more towards financial planning, where covering all the topics we brought up in the beginning, the cash flow, let's figure out goals. Are we managing towards these things? What are my insurance needs? Is my estate in order? So you want to make sure what you're paying for, and hopefully you're covering all those topics.
Right. Life is so complicated. So particularly, I think, towards aiming for your retirement and even end of life planning. So for years, some people said, oh, you buy annuities and that will give you the money and that'll be good for helping to pay healthcare costs as you get older. But now there's this ad that seems to keep popping up on my computer, you know, press here, get the book on why you should never buy annuities. And I'm like, oh, like I don't understand enough about annuities to know whether I should buy them for my older years or I should stay away from them. I don't even quite understand that one. Somebody want to take a stab quick?
Yeah, I'll
All you,
start, I
Ed.
guess. So an annuity, it's something that has been popular over the last few decades, becoming less and less popular. And basically, it's mostly offered by insurance companies where you may have saved a sum of money, let's call it $500,000, and you give that all to the company, and they agree to pay you an income stream for the rest of your life. So it takes away some of the uncertainty, which is understandable. And that's to supplement your Social Security and whatever else you might have. But these products generally, and still to me, are quite complicated, and you don't know what the fees are. They're opaque, and they're usually sold by someone in an insurance company. So our general philosophy is they're not appropriate in most circumstances. If you built up this portfolio, it can be managed properly where it can meet your goals and you can live off of it. And perhaps at the end of your life, you have some of that portfolio left to give to your family instead of giving it to an insurance company. So I don't want to kind of oversimplify it, but we feel they're mostly not appropriate for most people. However, they are getting more transparent in their fees, and I think they are coming around a little bit. But if that's something you're interested in, I would definitely seek out professional help. And again, try to make sure the person you're getting guidance from is someone independent and not the one actually selling you the annuity.
Got it. Okay, we only have like 2 minutes left. So someone just wrote in, if I have a retirement fund at TIAA CREF, can you advise me about something like that to help me with my big picture? So I know there are a firm that handles retirement accounts for people in academia, and I think the not-for-profit world, and maybe some other institutional worlds now. So as we're thinking about planning, if we're in one of those retirement funds, what's your opinion?
Well, we have lots of clients at TIAA CREF. You're right. A lot of I think it really started in academia, really branched out to a lot of nonprofits, but anyone can open an account. But a lot of retirement plans are there. There's usually plenty of options, and people can leave them there. And it's basically, they have a lot of 403Bs, which is similar to a 401k, but a TIA is basically like a Schwab or a Fidelity. It's a custodian who also offers some products there. And when you retire, you have the option of rolling that into a different type of account or keeping it there. But it's just something you can, any financial planner can help manage with that if that's where your funds are.
Got it. All right. Well, it is actually 5 of 8, and we promised that we would close this down by 8. So I want to thank you both immensely for your participation. And I will also say lots of people were asking for the name of your firms, but I feel like that wasn't part of the deal. I'm not supposed to be sharing that. I suspect people can look up your names and find where you work if they like. But you're here to represent your association and the work that certified financial advisors offer to people. And I think it is so important that we discuss the fiduciary responsibility role and the differences between people. I mean, some people just say, hey, I'm a financial advisor. They may have absolutely no qualifications, no training, no ethical or legal requirements to handle your money in a certain way. So I definitely want to encourage people, just because somebody might call you up and cold call you to sell you things, please don't just hand your money over to them, because those are the tragedies that you usually can't fix afterwards. So I do want to thank both of you tonight for your great presentations, and your association for working with my staff to pull together all 3 of these sessions. They've been very valuable. I want to tell everyone that our upcoming events include our virtual senior resource fair, which has gone virtual now for multiple years because we just don't think it's great to put 800 people in one room anymore. So the topics and dates are October 24th, Aging Alone, October 25th, Caring for Caregivers, October 26th, Nature and the Environment. They'll all be in the afternoon from 2 to 3:30. And I do also want to announce we are having our first in-person town hall since the COVID shutdown. Hopefully we'll get that one done before COVID explodes on everyone again. We're holding that on Tuesday, October 31st. That's Halloween evening. Candy will be involved. And it will be at Carnegie Hall from 6 to 8 p.m. Our topics will include key policy and legislative issues for the upcoming legislative year. We're going to have Manhattan DA Alvin Bragg, along with 2 other special guests, I think talking about housing and transportation, and I'll be talking about a whole list of things I'm working on. So you're welcome to come in costume, or just wear something festive, or wear your basic New York City black, however you'd like to dress on Halloween evening. Again, information and RSVP options will be sent out in the beginning of October. Again, I want to thank my staff, I want to thank my special guests, and I want to remind everybody, stay safe, mask up in indoor public spaces, wash your hands, and go find and sign up for a COVID shot and a flu shot. It's the right time of year for flu shots also. Anyway, thank you so much. See you next time. Bye.